Hello everyone, welcome back to another Lunch and Learn webinar series. I'm your host, Mayur Thaker. I am an equity strategist and portfolio manager here at Zacks Investment Research, and this is a S&P 500 Q4 2024 earnings recap. We're going to talk about what kinds of things happened and trends of S&P 500 earnings through Q4, now that we have most of companies in the S&P 500 fully reported for the fourth quarter and for the full year of 2024. And we're going to look at some of that and the trends that we have seen develop to basically create an outlook for 2025, along with what analysts are saying and doing with regards to their expectations for 2025. So let's get started with that. And if we go into some of the data, we will then see several interesting trends that have been going on. First and foremost, we have the S&P 500 decomposition. So I have on here a chart that shows the earnings growth year over year for the S&P 500. In that green line, the dark green line there, is the S&P 500 total profit growth year over year. As we saw, exiting the pandemic surge, we saw growth significantly normalized. In fact, we entered an earnings recession in the first part of 2023. As we can see there, earnings growth year over year fell below zero, but that's, again, because of very high comps in the year before, where we were still growing at north of 20%. And that was, again, due to the COVID reopening and inflation that really ignited in 2021 and 2022. So the earnings breather that we saw in 2023 was really not much as far as surprises go, because it never really devolved into a recession, as some people, including myself, were thinking in around that time period. And since then, since we got back to normalization, we cycled out of those extremely high comps year over year. Now we're back to growth, and we can see growth accelerating through Q4. As we see here, the S&P 500 aggregate is the line at the very top there, as you can see. And then I've also decomposed the S&P 500, because one of the big concerns that I've had, if you've been following my write-ups and these videos, is that a lot of S&P 500 growth has been attributable to the mega cap portion of the index. In fact, mega caps now, the top 10 of the S&P 500 index, reached a fever pitch 40% of the index, which is unprecedented. It's an all-time high. It's never been that high before. It reached a peak of about 30% at the top of the dot-com boom in 2000, and we have now surpassed that, today, at least through Q4 of 2024, where the top 10 is now, accounting for 40% of the index. That's never been that concentrated in S&P 500 history. And so, it's one thing to have strong earnings growth for the S&P overall, because the S&P is so heavily tilted towards the mega cap tech sector. And so that's why I put, a decomposition of earnings here, where we can also see in the very dark line, kind of hard to see maybe on the black background, but, as we saw for the most part, and even through 2024, much of 2024, earnings growth, simply excluding the Mag 7, was a negative. And so if we just remove 7 companies and only looked at the S&P 493, earnings were still negative through the first quarter of last year. But as we've seen then after that, starting in Q2, sort of slowing down in Q3, and then really accelerating into Q4, the growth in earnings is starting to broaden out, and that's been a very, very important and bullish development because now, the earnings growth of the index is not as skewed to the mega cap 7 as it once was. And now we're starting to see earnings growth participation from a much broader swath of the index. And so that's why if you see in that in the cream colored line, this is the median X Mag 7 year-over-year growth, and you can see that also accelerating. So if you wanted to see this in table format, this way it's a lot easier. You can see that total profit growth, again, very bullish, very strong. We saw that be the case for basically the second half of 2023 and all of 2024, and also the trend has been bullish as well. We saw pretty good, from negative numbers to then positive numbers to then increasingly positive numbers to now double-digit numbers. We saw a little bit of a breather in Q3, but then wow, a 15% knock, hit in terms of year-over-year growth. That's basically a home run right there. But again, a lot of that has been dominated by mega cap 7, the Mag 7. So even through the first quarter of 2024, as I showed, X Mag 7, we were still negative. This is all negative growth here. And yet, the market was hitting fever pitch already before that. So I was worried that too much of the index is being driven by too few companies. And the truer, broader economy has been in an earnings recession. And that was true through Q1. But now we're starting to see, even outside of the big 7, earnings are not only positive, but accelerating to the upside. And we saw now through Q4, X Mag 7 year-over-year growth, 10.4%. That is phenomenal. And then if you look at the median, so that way we're not only looking at the big caps, right? Because even if you subtract out the Mag 7, there are still very large companies, right, out there. And so, even with this, these numbers could be skewed by, those very, very large companies. So if you look at it on a median basis, even the median basis is showing accelerating growth. So again, this is very bullish overall. These are very, very impressive numbers. However, there are some soft spots. Retailers, ex-Amazon, reported 3% earnings growth year over year on 4.3% revenue growth. That's not bad, not great. It's just right in the middle there, kind of mediocre. Not anything to be concerned about just yet, at least through Q4. However, tariffs, that's been a big concern. Management is talking about them a lot more on the calls. And so tariff threats are weighing on their guidance for fiscal year 2025. Target, for example, they guided lower, partially due to tariff threats. Best Buy, they withheld any guidance because of the uncertainty, because of the fluid nature of these negotiations, and we just have no idea, what President Trump is going to come out with tomorrow versus today. It really waves, in terms of how the negotiations are going, but also with how aggressive he's feeling one day versus the next. So, it's been a fluid situation. We really have no idea how the chips are going to fall. And that's why more companies are just withholding guidance within retail. I remember a lot of things that are imported from Canada or Mexico that's going to impact margins for retailers specifically, especially. And so because of that uncertainty, because of pulling guidance, we are seeing earnings estimates decline for retail, and that's a very important sector because it is one of the cyclical sectors, and we're going to take a look at that, and I'll talk about that a little bit more. But cyclicals are a very, very important segment of the economy, and I use that term cyclicals as opposed to growth. Growth are obviously, the companies that are, household names by now, most big cap tech and many others. Growth is great. That's where the returns have been, but it's very important for analytical purposes to keep track of what cyclical companies are doing and how they're growing or not. because that is a reflection of the true underlying business cycle, as opposed to secular compounders who are growing because of their own reasons, because they're just really good at what they do, because they have investment opportunities that their management has identified. Obviously a lot of economic growth comes from the growth segment of the economy, but it's not advisable to ignore the cyclicals, right? The cyclicals are the companies that don't really grow much over time, but they, wax and wane. And that's because they have reached maturity in their respective areas. And, they then become companies that are relevant for analytical purposes because they actually reflect the cyclical economy rather than secular compounders. So they're a much more accurate and analytically relevant segment to watch, for clues on whether we are entering recession or whether we are entering accelerating economic growth. Technology sector EPS estimates are starting to fade as well. That's another, what was once a tailwind may now be at the early stages of becoming a headwind, right? Because we've seen estimates constantly rise, but now are starting to fall for the first time in well over, I believe, 2 years. So we're seeing that. However, despite this uncertainty between retail due to tariffs and technology estimates starting to wane, despite that, the all-important cyclicals are seeing accelerating growth. And this is why I believe retail is so important. But cyclicals overall, and we're going to take a look at it, how we define that in just a minute here. But S&P 500 cyclicals are now back to positive growth after being in recession for quite a while. I believe it was 8 quarters, right? You can see on that next table there, but just let's take a look at this chart right here. Typically speaking, S&P 500 cyclicals rarely ever enter contraction outside of recessions. Now, we entered contraction in, what was that? The fourth quarter of 2022, as we see there. The fourth quarter of 2022, we entered contraction on earnings, but you can excuse the first couple of quarters like that just because we were coming off of an unprecedented comp where, that massive surge, as we came out of the pandemic, it becomes, exceedingly difficult to actually continue to grow on such a big comp like that, right? When earnings basically, tripled from the pandemic lows, right? So those are a very difficult comp. So it makes sense for us to go into contraction, at least for a couple of quarters, but that persisted all the way up until the fourth quarter of 2024. And so now the median S&P 500 cyclical company has grown earnings on a year-over-year basis by 5%. And total, if you look at the aggregate numbers, meaning the aggregate S&P 500 cyclicals, we are seeing very, very solid growth overall. We're seeing solid growth continue, and that's been the case actually since Q4 of 2023. However, that total number is dominated by very large companies, some of which are a part of the Mag 7. So that's why the median company is a better number to look at. That tells you how, a greater sense of how cyclicals in general are doing. So that way it's not skewed by a couple of really, really big names. And we saw here that for 1, 2, 3, 4, 5, 6, 7, 8 quarters in a row, the median cyclical company in the S&P 500 has been in an earnings recession, right? And like I said, we can excuse the first couple of quarters there because we're off of very, very strong comps. So it doesn't make much sense. It's kind of unrealistic to be expecting companies to be growing at, 20% plus in perpetuity, right? Especially if they grew 206% in one quarter, 83% the quarter after that, 63, 36, 18, 9. These are very high comps at this point. And so it makes sense, and you can excuse them for, having an earnings contraction, but this persisted for 8 quarters now. So that's why I was very concerned about that. Typically, S&P cyclicals do not enter earnings recession without the broader S&P 500 entering an earnings recession. And so that's why I was very concerned throughout 2024, but Q4 of 2024 was our first quarter getting out of that. So the trend is very bullish in my view. So while growth dominates returns, obviously growth has been where returns have been concentrated now for more than a decade, really exiting the great financial crisis of 2008. Growth has really crushed returns. Value, meaning cyclicals, have really lagged behind. However, that's not to mean that we should ignore these cyclicals. So I use the term cyclicals. More traditional people call them value stocks. I like cyclicals. I think that's a better term to use to describe them because they shouldn't be confused as being value stocks, meaning just because they are low PE, typically speaking, doesn't mean that they represent a good value to invest in. However, I look at cyclicals from an analytic standpoint to understand where are the direction of earnings trending in. Are earnings trending positively, or are they trending negatively? And it's very, very important to answer that basic question, because the answer to that question tells you the direction of the true underlying economy. So again, cyclicals have great analytical value as a reflection of the true underlying economy, not by companies that have found ways to invest their capital because of innovation, but companies that have reached maturity in their respective industries and are simply reacting to macroeconomic factors. That tells you the true underlying economy. So here you can see it in visual representation. If you take the S&P 500, that's here in orange. Those are the S&P 500 earnings over time. And you can see that over a 25-year period, or almost a 30-year period, S&P earnings are up 650%. But if you disaggregate them, these companies into two distinct buckets, growth and cyclicals. Again, cyclicals typically are called value stocks, but I think cyclicals are a better term to describe them. If you disaggregate them, you can see growth is where most of the returns are. But these are the companies that lead innovation, right? And not to ignore them, but by looking and disaggregating these two, you can see where the recessions are starting to build. And you can see that recessions started to build around 2019 into 2020. So this is a separate discussion, but I believe that if COVID never happened, I believe we might have already been descending into recession anyway, right around that, 2020, maybe 2021 year, but we'll never really know the answer to that. Just tracking how these companies are doing are very, very important because they reflect the true state of the business cycle, right? And here are some of the key companies. I use this term cyclicals as an aggregate number, as an aggregate term, but let's look at who they are. So if we double click on that, these are some of the companies that are bellwethers in the S&P cyclicals. Freeport-McMoRan, American Express, Marvell, right? And then Martin Marietta and Vulcan Materials Companies are obviously materials and miners. Cummins, right? These are companies that are industrial / material / financials, right? Like in the case of American Express. And in the case of Marvell, right, their earnings are very cyclical because they track the waxing and waning of semiconductors over time. So their earnings are very cyclical based on supply and demand of electronics that they support. A lot of that goes into consumer electronics. So that is a very cyclical industry. So it's important to track these on the aggregate because they do tell you the state of the underlying business cycle. And here you can see an overlay to that. I have, this is a chart that you should be familiar with if you've been, watching and following these videos that I've been making over the past several years. This is a chart of the ISM Manufacturing Index that's in yellow, right? And manufacturing is the ultimate example of a cyclical industry because, as you can see, manufacturing does go through, cycles like this. And typically when it plunges, below 50 for an extended period of time, we've been in a confirmed recession. And, we were actually under 50 for about 26 months. We only very briefly, went above it for a month or so. But I believe we were in contraction now for 26 out of roughly 27 or 28 months. That was one of the reasons why I thought we were entering recession. And that was confirmed by S&P's cyclical earnings. You can actually see that the ISM Manufacturing forecasts the cyclical, S&P cyclical earnings to a very, very great extent. You can see that, as ISM Manufacturing declines, you can see that cyclical earnings start to decline. And as the ISM Manufacturing Index recovers, you can see cyclical earnings also recover. So again, these are very, very important just for analytical purposes, not so much as an investment thesis, but also primarily because we want to know the direction of the general, business cycle. And so as we were in contraction in manufacturing, S&P cyclicals have been in an earnings recession, but now look what's happened to the ISM Manufacturing. For the first time in back-to-back months, we have seen positive readings in both January and February. That's been a big break from what we have seen for the past 2.5 years. We haven't had back-to-back ISM positive readings on ISM, since we exited COVID back in 2021, 2022. And prior to that, really hasn't been that way since 2019. And so this is a big shift in the trend. After spending a lot of time underwater, we're now finally getting back to positive expansion. So that is very bullish for cyclical earnings. Why? Because if you run a regression against the two, you can see, statistically speaking, the ISM Manufacturing PMI shares a 77% correlation with S&P cyclical earnings with a 3-quarter lead time, right? So this is a leading index, meaning the ISM Manufacturing Index leads cyclical earnings by roughly 3 quarters. You can see that there. This is a regression that I ran using our Zacks Research System software, and there you have it. A 77% leading correlation with an optimal lead time of 3 quarters. So that's very bullish. So if this continues, basically if we continue to see this positive momentum in manufacturing, that to me is very bullish for S&P cyclicals, right? So if American manufacturing, again, sustains that recovery, we could be at the very early stages of a cyclical earnings recovery. Again, cyclicals basically means companies that belong to transportation, retail, consumer discretionary, industrials, also materials as well. These industries are very, very important. Why? Because, again, we have been riding on the coattails of technology now for 2+ years, right? Going back to this chart that I just showed you, right? We have been, the average company in the S&P 500 cyclicals has been in an earnings contraction for 8 quarters in a row. That means that, this entire index, the entire S&P 500, primarily has been riding on the coattails of a very few select number of companies. If I go back even further to this table right here, again, mags, if you take the total S&P 500, again, you have very strong earnings growth, but a lot of that, basically all of it, came from 7 companies. As recently as Q1 of 2024, it only started getting good in Q4, really. Even with these positive numbers here, again, a 5% earnings growth outside of Mag 7 is not a number to be very excited about. And then it fell to 2.6% through Q3. Again, these are not very exciting numbers given the valuation of the index being at almost 23 times forward earnings. That's a very bull market PE. And yet we were not getting much growth outside of these 7 mega companies. Only until Q4, we haven't gotten that. Starting in Q4, we are now starting to see that earnings recovery broaden out. And that's why this is very, very important in my view. So again, if I were to go back to this point over here, so far we have been entirely dependent on Mag 7. So if American manufacturing is at the cusp of a recovery, as ISM Manufacturing seems to be suggesting, with 2 back-to-back positive readings, that's very, very hopeful. This would significantly ease the burden on the Mag 7 carrying the market solely on its shoulders. We would see widening breadth of earnings growth. That would be very, very important. And again, despite this volatility coming from all the tariff talk, estimates so far for 2025 and 2026 remain remarkably stable. We can see that they're off the highs, from back in August. It's off the highs now. You can see that estimates for 2025 for the average S&P 500 company has been revised down from $6.47 down to $6.34. But that's not a big change from where we were a year ago. So again, these numbers are looking at the average, the market cap weighted average S&P 500 earnings estimate and how that has changed over time. So you can see that they've been revised down over the past year by basically nothing, down minus 0.2%. So yeah, not much movement on earnings estimate revisions. Same thing for down here. This chart shows you the expectations for next year, 2026. Off the highs, but still higher than where the expectation was a year ago. So really not much movement, not much negativity, not much positivity, but the growth expectation is still there, and it's still quite strong, with analysts expecting roughly 10%, a little bit more than 10% growth year over year this year for the S&P 500, and a lot of that is coming from broadening out of earnings. Especially from these cyclical, companies that seem to be getting some momentum here. So again, I would say do not fear the tariff. It's just meant to negotiate better terms. It's just, the way Trump wants to do things. It's his way of negotiating a better deal out of other countries to get a favorable outcome. It's really not meant to penalize anybody. It's really not meant to actually make companies pay these tariffs. It's basically meant to encourage companies to circumvent the tariff by directly investing in the U.S. for manufacturing and hiring, or to simply negotiate a better deal with foreign governments. So the tariff is just kind of a lot of talk, although some of that, you can see that, for example, during his first term, tariffs doubled. Tariff revenue that the government took in doubled in his first term from 40 billion to 80 billion. That was a big impact on tax revenue. However, it had no impact on the CPI. So I would say that, I would not be worried just yet about tariffs' impact on the CPI. Again, because first of all, the situation is very fluid. I don't think it involves blanket tariffs. A lot of these tariffs are targeted on certain countries or on certain industries. Certain industries are exempted. So it's really not a science. It's more of a targeted threat to foreign governments to say, hey, we don't like how you guys are taxing us on imports into your country. Give us a better deal. So at the margin, that's going to help American exporters if, the reciprocal government, does what, Trump wants them to do. So that's a big if right? But we saw how this played out in his first term. Tariff revenues increased, indeed doubled, but as you can see here in the red line, didn't have any impact, really any measurable impact on CPI. So I really wouldn't fear all this tariff talk. So again, these threats of targeted tariffs are just his way of negotiating a better deal. However, if the goal is to actually extract revenue, meaning if they are, blanket tariffs, regardless of industry or regardless of country, that would be anti-growth, and that might be inflationary if that's actually how they do it. However, if some of that is offset by tax cuts, which, some of the talk now is that if they can, generate enough revenue from tariffs, they could sunset, some portion of income taxes entirely, then that would be bullish. It just really depends on the details, right? The devil's in the details. But as we saw through objective data, as of right now, based on what we know, the way Trump has executed the tariffs in his first term had no measurable impact on consumer prices. So I continue to expect the same thing happens this time around. And they can be very pro-growth, to the third point, if the goal of the policy is to force foreign countries to reduce their import tariffs on American exports. That would actually open up new markets for American builders, American manufacturers, American companies to sell into. That's bullish for earnings and revenue. Tariffs can also be pro-growth if they successfully convince companies to invest directly in America. So even if you have a 25% tariff on a country, if very few companies actually pay that tariff because they set up shop in America, then it's really not that bad of a thing. In fact, that's a bullish thing because that would be bullish for jobs in the U.S. So ultimately, the point of high tariffs is for very few companies to actually pay them, right? Because they successfully open up new geographic markets for American companies to sell into, or to incentivize companies to build in the U.S. Either option is bullish for the U.S. economy. And it becomes even more bullish if the policy is paired with tax rates, favorable tax rates for businesses. Right now, they are talking about taking the corporate tax rate down to 15%. That would be very bullish in my view. So again, all these policies are bullish in the long run. However, there is significant possibility for short-term pain with the markets priced at highly elevated multiples as they are right now. So if, that transition, right, we are at least attempting to transition from debt-fueled economic expansion to a savings-fueled economic expansion. And it won't be easy, and will serve many speed bumps along the way. Remember, we had very solid real GDP growth for 4 years, but it didn't come without a steep cost. And that cost was, record government deficits, right? Fueled by, record government spending and significant interest expense. Part of the reason for that was because we were coming up with a lot of debt coming due, while the Fed was hiking interest rates from historical lows to basically the highest rates in 20 years. So that has led to a very substantial deficit, right? But the Trump administration now is committed to transitioning us from debt-fueled growth to savings-fueled growth, which fundamentally speaking, that's very bullish in the long run. But it won't be easy, and it's going to be bumpy. And I think that means that there's going to be volatility in the S&P 500 until we reach a point of stable growth after that. So I, continue to recommend being in the S&P 500 for now, but take a very strong look at the ECP, the Zacks Earning Certain portfolio. This is our portfolio of high-quality, steady compounders. These are recession-resistant companies that have been through all kinds of macro volatility for 20 plus years, and also the Zacks Deep Value portfolio. These are high quality cyclicals trading for deep multiple, trading at deep multiple compression. So again, takeaways, the S&P is still very rich at 22.5 times forward earnings. That means that there are very bullish growth expectations still being priced in. That means that the bar is very high. It's in the top decile over the past 30 years. The forward earnings yield of the market is basically at parity with the 10-year yield. Historically, whenever we've gotten to this type of earnings, equity risk premium parity like that, market returns over the next 5 years have been very poor. But the bullish side of things is that if ISM Manufacturing turns, which it looks like it has, that would be very bullish for S&P 500 cyclicals. And if cyclicals finally return to earnings growth, that broadens the breadth of the market's earnings growth. And that would make the current market valuation not as expensive as it might seem, because the earnings are then more sustainable because it's not just on the backs of 7 really big companies. That's very important to increase the breadth of earnings growth. So my main takeaway here is that I would still remain long the S&P 500 as long as it remains above the 10-week average true range. This is a trading principle. I highly encourage you guys to take a look at it. You can do a quick Google search on it or search on YouTube for it. But if you want to learn more about it, I've recently started getting into this technical indicator called the average true range. It basically builds a math-based stop loss level based on the volatility of any security that you're looking at, whether it's the S&P 500 or any individual stock. And so it gives you a more relevant stop loss level. It basically helps you understand the structure of the market. Are we in a general bull market or are we in a general bear market? And it gives you these stop loss levels either on the bullish side or the bearish side based on the security's own volatility. It's a measure of its own volatility. And I use the 10-week setting for that. And currently for the S&P 500, that level is at 56.75. So as long as we remain above that level, 56.75, I would remain long the S&P 500. But in my view, the best gains, over the next 4 years are going to come from high-quality cyclicals with strong balance sheets, good returns on capital, and attractive valuations. And so that is essentially, going back to the last slide, the Zacks Deep Value proxy. Again, these are our selection of high-quality cyclicals trading for deep multiple compression prices. So here are a couple of examples of companies that are in the Zacks Earnings Certain proxy. Again, high-quality companies, highly recommend these companies, recession-resistant. They're very durable, moat-protected businesses. A lot of them, most of them are low-volatility companies, steady compounders, companies that are really unaffected by recessions, unaffected by macro volatility, steady as she goes type companies. So here are some of the examples of them. As you can see, these companies don't have any earnings volatility. They, continuously compound over time. So they are great buy and hold investments. I really believe that this should be the core of anyone's portfolio, these companies right here. And then you can supplement them with, bullish tilt when the time is right to be bullish, and exit those tilts when the time is right to be bearish. And again, this is built for long-term durability, the Zacks Earnings Certain proxy. And here are some of the companies that we own in the deep value portfolio. These are cyclicals that are trading at a great price, but also companies that are industry leaders, companies that generate attractive returns on capital, high-quality companies that throw off significant free cash flow, very profitable companies trading at a good price relative to normalized earnings. So these are just a few examples of them. So if you needed more information about either of these two portfolios, if you had any questions with any of the content or materials in this webinar, please do reach out to us. I'd love to hear from you. You can reach us at 1-866-794-6065 or send us an email to strategycall@zackspro.com. All right, thanks everyone. Talk to everyone soon. Bye.